All right, folks, I'm ready to get started here. Welcome back, everybody. Welcome to the last day we're going to meet before the first exam, which I'm sure you're all super excited about. But, regardless of how you feel about it, it is part of what we do here. I teach, I test you. I have to make sure you're actually listening to me, that something is actually getting through to you, and you're actually going to walk away from this thing with some more information than you had when you started. So, I hope that you will be well prepared for the exam come Tuesday. I've talked about it already last Tuesday, what you'll need. I sent out an email, so all the information is there. Make sure you look at it. Make sure you figure out what you need and come prepared. And beyond that, just spend as much time as possible. Just kind of collecting your thoughts with respect to what we've covered so far. Like I've said before, you shouldn't be leaving learning until the end. You should be learning as we're going through the material and then reviewing everything right before the exam, just so you make sure you have it all down, so you have a good outcome on the exam and everybody feels good about what's being done here. So that's what I want to happen for the majority of you that are familiar faces to me that are coming to class on a regular basis. You're demonstrating a lot of commitment already. I'm sure that things will work out well for you. The sort of the uncertainty lies in the empty seats. We'll see what happens there. But also, if you have been coming to class regularly, that's not enough. You need to be working on this stuff outside of class. So I hope you are. I hope you are doing what I've asked you to do. Going through the material again, either going through the lectures again or reading the book again, filling in your notes, transcribing them, making yourself study guides so you have it all kind of ready to go. And now you're just ready to kind of like review everything and have it down by Tuesday. So if that is what's been happening, that's what will occur, and the outcome will be good, and that'll be a good thing. Yes. It depends on how the class does, but I mean generally, yeah. But curves are not something you should depend on because you never know how people are going to do relative to you. You never know what kind of group you're around. And also in life, there's no curves. Like once you get out there, there's no curves. Either you're putting in everything you have to get ahead or you're not. If you are depending on just like how everyone else is going to do around you here and that is going to get you by, yeah, it'll get you by here, but it won't get you by out there and you will fail out there. Yes. You don't need any of that. All you need is to focus on the stuff that I've been telling you to focus on. If you go through a bunch of problems in the book, they're going to take you in directions that don't necessarily need you to go in. If it was something I needed you to go in, then I would have assigned it. So you can do whatever you want with respect to all the tools available online. The best ones, though, are the ones that there's this. I forgot what it's called. I think it's called. I don't know what it is. It's a system where like it gives you multiple choice questions and then you answer it and it's either right or wrong and then it tells you the answer. So I forget. It's a section of the Launchpad system. Like look through it. That's a tool that you could use and it will give you the answers. Either you're right or wrong. So use that if you want to use something online. That's probably the best tool to use. Other questions? Yeah.
How closely related the sample test
It's going to be exactly like the test you're going to take.
so
It's going to be the exact test.
if you,
I'm just kidding. The format. You're talking about the format.
yeah,
Okay, yeah. Some people assume that the content will be exactly the same, and that's where they make a mistake. But yeah. The structure will be the same. Yeah, 50 multiple choice, 4 open answer with multiple parts. All right, so just make sure you come ready. Make sure if you don't know what you need to read that email that I sent, and you will know. I've talked about it enough, so we don't need to talk about it anymore. So let's jump to the material, which will get us to the end of the last chapter we're covering, which again is focused on international trade. Again, we're using the tools that we've been using to kind of analyze the effects of international trade. We use the comparative advantage production possibility frontier framework to analyze it, to once again establish that there can be gains from trade. So make sure you understand how we did that. Make sure you understand how to calculate everything, how that model works, etc. And then we started talking about analyzing the effects of trade via our market model. That's been mainly our workhorse model for this first part of the course. And so we're going to continue doing that today. Last time we started looking at imports and the effect on a domestic market. Then we'll look at exports, and then we're going to jump into like government intervention in international trade with respect to taxation, which comes in the form of tariffs, taxes that are placed on imports, goods that are being bought from overseas, and also another kind of policy the government could enact is a quota on how much can be imported. So we'll look at the effects of both of those on the market and just analyze them via the tools we have, and then we'll just touch upon some like ancillary important issues related to trade, such as trade policy, different trade unions that exist, and then we'll call it a day. All right, so let's move forward. Right. And just really quickly, we started. Well, I did talk about comparative advantage last time on international trade, and then we talked about the Heckscher-Ohlin model as one of the ways that we can explain how countries have comparative advantage, the various sources of comparative advantage. The Heckscher-Ohlin model tells us that if a country has a factor abundance, meaning like they have a huge amount of a certain factor of production, like labor, let's say, then they will have a comparative advantage in producing goods that are factor intensive in that factor. So if they're labor intensive, so if the goods are labor intensive, like they are in China, like the like iPhones, etc., it takes a lot of like manual labor to put those things together. Then a country that has a lot of labor, has factor abundance in labor, like China, will have the comparative advantage in putting phones together. So that's one thing we talked about. Yeah. An overabundance of labor relative to the other factors of production, like capital, that exist within the country. Well, we have a comparative advantage in a bunch of different things, but I mean, if you have to think about okay, so if we're talking about agricultural products, like we have a comparative advantage in a lot of agricultural products because we have a lot of land in this country. So, like we have that part of the production process. Climate has to do with it. Climate's another one. We talked about all the different ones. Yeah, that's one of them. Yeah. So it just depends on like on the well, as far as us, like yeah, we have land, so definitely agricultural products, but we also have a lot of capital. And capital can take the form of like knowledge and skills. So we have a lot of human capital that allows us to produce things that require like advanced technical know-how, and those things are generally going to be very capital intensive. So like we talked about oil being one of them. We have a lot of like advanced technology that helps us to extract oil and produce it. It just depends. There's so much. But yeah, ultimately, like the sources of comparative advantage come down to the ones that we talked about last time. Make sure you understand what those are. And then we started talking about supply, demand, and international trade. So the way we looked at it is we assume that the countries that we're analyzing in very general terms are initially in autarky, meaning that they are not trading with other countries, and then that there is trade that starts to occur. So initially there's demand, there's supply, and the demand and supply curves represent domestic demand and supply. They don't represent international demand and supply. And in autarky, in a situation where a country is not trading, there's going to be we're assuming an efficient market outcome in which consumer and producer surplus is at its maximum. And there's going to be some world price for the good that's going to likely be different from the autarky price, which will then create an incentive to either import or export. If the world price is below the domestic autarky price, then that means that things could be can be bought overseas and then resold here for a higher price. So that's what we call an arbitrage situation: buy low, sell high. And if the world price is above the autarky price, then the country will benefit from exporting because they can produce something domestically that's being sold at a lower price than it is being sold internationally, and thus a profit can be made selling the goods internationally. So again, we examined the first situation of the world price being below the autarky price, which means that the countries would then start to import. So this was like the market for phones. The world price was below the autarky price, and that means that that there are importers domestically that obviously will jump on the opportunity to buy low and sell high domestically. What that winds up doing is increasing the supply within our country, but we don't see the supply curve shift because this is the domestic supply and that's international supply that's coming into the country. So if you have a case like this where this is the world price, then you're going to have a domestic supply that is represented by the amount of domestic suppliers that can afford to supply at that world price, because once the country opens up to imports, then the domestic suppliers are going to have to compete against that. And so all these folks over here that we're selling domestically at the higher price, whose cost to supply is either at or below the autarky price, will no longer be able to supply as a result of the price of the good dropping down to the world price domestically. And so this is how much will be supplied by domestic suppliers at that price. Looking at domestic demand, this is how much will be demanded of phones by domestic consumers. And so the difference between what is being demanded and what is being supplied is going to be supplied by international suppliers. And those are going to be, of course, the imports. Yes?
And you know how California or like the states have like their own borders for like I can find in New York. So remember, like Trump used to like push this theory that if you like got rid of the borders and increased competition, it would lower the price of premium. So would that be like the same idea, or like you're creating more competition and like
So it's different. It's a different situation because again, like we're talking about states versus other states versus countries versus other countries. Let's not get into that. I don't want to. That'll take me way too off topic. We can analyze that situation, and if you want to analyze it, come to my office and talk about it. But yeah, that's it. But I mean, let's not talk about it. Let's talk about this, because you need to understand how the markets in general, in the most basic form, not thinking about specific unique situations that could or cannot be related to what we're talking about, which is good to talk about, but that's the more complicated applications of this stuff that you need to get to once you have all this down, once you have the basics down. So let's continue just looking at what happens to the markets when, in this case, we're importing. Again, the difference between quantity demand and quantity supplied are going to be the imports as a result of the world price being below the domestic autarky price, the price that prevailed in markets when there was no trade. And then we examine what happened with our surplus as a result of us importing. And when there's imports, when we're opening up the trade, there's going to be winners and losers. If we're talking about imports, we saw that the winners were the consumers and the losers were the domestic suppliers. So as far as consumption goes, so here is, again, the autarky situation. There's our full consumer surplus. We are now in a importing situation. World price is below domestic autarky price. So now all these new consumers are able to buy. That means all these consumers are able to buy at this price. That means all of them have an excess willingness to pay. So they all have consumer surplus. So now consumer surplus went from W to W plus XZ. And so the increase in consumer surplus was X plus Z. And that added total surplus because this area before was not part of either side surplus, either consumer or producer. And then down here we've got the existing producer surplus that results from just the few domestic suppliers that are still able to sell at the world price because their individual cost of selling is below that world price. And so they're going to have some producer surplus, but they're going to lose, of course, this part of producer surplus, which is transferred over to consumers. So consumers win, and of course the country wins overall because they do wind up with that extra surplus that they didn't have before. So that is what represents the gains from trade via this analysis. And again, remember, when we started this section, we mentioned that we assume here, as is the realistic case, that we have incomplete specialization, meaning that with the comparative advantage model, if a country had the comparative advantage in the very simple cases that we considered, then they would just produce that one good, and the other countries that had comparative advantage in the other good would produce the other good, and then they would trade. But in reality, that's not the case. Countries that have comparative advantage will continue to produce the goods that they don't have a comparative advantage in, but obviously the majority of producers will produce the goods that we do have a comparative advantage in. And so that's what we call incomplete specialization, and that's what we're analyzing here. We're analyzing that situation where you have incomplete specialization. In this case, we don't have the comparative advantage in phones, but we still have some domestic producers that are willing to produce phones. Yeah. So because then you're going to have the importers, like those folks whose business is to import, they're going to be buying abroad at a cheap price and they're going to be selling domestically. And so they're essentially going to be competing against domestic suppliers, right? So effectively, if you were to examine this as just a world market, then the supply would increase, and therefore you would move down the old equilibrium to the new equilibrium, right? Like you would wind up in a situation where at the world price, you'd have that excess demand, and then so it's just standard market forces. But because we're dealing with like domestic versus international, we don't see the curve shifting, and so you just kind of have to understand that it is still market forces that are driving the price down. It's competition. All right, so that's the gains from trade from imports. Now let's look at exports. So again, exports, we would export if the price in the world markets is above the price in the domestic market. So we assume that unlimited quantities of trucks can be sold abroad at a given world price PW, which is higher than the price that would prevail in the domestic market in autarky, which would be PA. So here's our world price. The higher world price makes it profitable for exporters to buy trucks domestically and to sell them overseas. And so the purchase of domestic trucks drive the domestic price up until it's equal to the world price. So again, we're starting over here, and then all of a sudden, essentially, you're going to have an increase in demand for our domestic good, but you're not going to see it because it's going to be domestic demand. It's going to be demand by international exporters, folks that are going to be buying stuff to sell them overseas. So that's not going to be satisfied by domestic demand. It's going to be satisfied by international demand. People are going to buy those trucks in overseas markets. So that competition will now drive the price up domestically. As a result, the quantity demanded by domestic consumers will now fall to this point here. So initially we were here. As a result of the world price being above us, exporters now start to buy stuff domestically and essentially start competing against domestic consumers, driving up the price for what's being produced to the world price. Domestic consumers, though, at that price are limited. These folks over here whose willingness to pay is now below the world price will no longer buy. And so domestic demand will only be represented by this quantity here, in which, again, this person and all these other folks over here have an excess willingness to pay and therefore would continue to buy at the world price domestically. at that world price, this is how much is being supplied domestically. So you've got a bunch of truck manufacturers that now are able to supply trucks at this new world price because it's meeting their cost of production. And so supply increases, but of course it does outweigh demand. So there is a surplus, but the difference between what is supplied and what is demanded will be sold to overseas markets. And so that will constitute the exports in that scenario, the amount of the trucks that are going to be sold overseas at the world price. All right, so exports will lead to an overall gain in total surplus for the exporting country, but also create losers as well as winners. And we can imagine that it's going to be the consumers that are going to be the losers in this case, because again, the price is being driven up above the autarky price, the price that prevailed in the market before we opened up to international markets. So again, here is the market in autarky. There is our consumer surplus. There's our producer surplus. As a result of trade, the price will rise from PA to PW. And so at PW, again, you're going to have all these suppliers willing to supply. As we know, the producer surplus is the area above the supply curve and below the price that they're able to charge, which is the world price. And so this entire triangle is now producer surplus. So producer surplus before was Y. Now we're adding X, which is part of consumer surplus, is being transferred to producer surplus. And we also have that new extra amount of surplus that comes from overseas, which is Z, which actually increases total surplus as a result of the market opening up to trade. Yeah. No. Just any situation in which the good that is being sold in the international market is being sold cheaper, like domestically. Any situation where the world price is above the domestic price, that will create an opportunity. These, you're saying the suppliers would make, well, they are going to be able to sell the extra amount though to overseas consumers, right? So yeah, the price will be higher for domestic consumers, and so yes, more affluent, more like richer people will be the ones that will be able to buy the good. But I mean, generally the price isn't going to go up that much. You know, it's just, even if there's small differences, like by a few dollars, like that may even be enough to warrant like us selling overseas. And you know, in large enough bulk, you can make a lot of money just even off a small differential like that. Yeah. So, but yeah, you know, it could be the case where like the price is driven up to the point where only like super wealthy people are able to buy the good. But again, like I said, yeah, suppliers will still be able to sell everything because international markets are okay with that price in general. So remember, it's a big world, a lot of people. So yeah. Yeah. And consumer surplus will get smaller because the price is going to go up. Exactly. Was there a question or something? Okay. All right. So yeah. So the loss in consumer surplus is going to be X, and that's going to be transferred to producers. And then we're also going to get that extra Z, which is also producer surplus. So overall total surplus increases, which means that there are winners and losers again. The consumers are the losers, and the producers are the winners. But overall, there is a net gain to the overall domestic economy, and that is in the form of extra surplus for suppliers. All right. A little bit about the relationship between international trade and wages. So one key question about international trade is how it affects factor prices, the prices of the factors of production, like labor and capital. The Heckscher-Ohlin model of trade states that comparative advantage is determined by a country's factor endowment, as I mentioned. The model also suggests that compared to autarky, international trade tends to raise the prices of factors that are abundantly available and reduce the prices of factors that are scarce. So if a country has a lot of labor and they are going to then produce goods that are labor intensive, that require a lot more labor, then that will effectively raise prices of that factor. So wages will go up as a result. The prices of factors of production, like the prices of goods and services, are determined by supply and demand. So there's markets for labor, there's markets for capital. Labor markets, the supply of labor is, the folks that are willing to work, and the demand is represented by the firms that are hiring. So think of a country's industry as consisting of two kinds: exporting industries, which produce goods and services that are sold abroad, and import competing industries, which produce goods and services that are also imported from abroad. So compared with autarky, compared with the situation in which there is no trade, international trade leads to higher production in exporting countries, exporting industries, and lower production in import competing industries. So again, like we said, like the firms that are still selling the goods domestically that we're generally importing will wind up competing against international producers, and therefore that's going to drive some folks out of business. It's going to drive also the prices down of the factors of production that they use to produce. In addition, the Heckscher-Ohlin model says that a country tends to export goods that are intensive in its abundant factors and to import goods that are intensive in its scarce factors. Again, they will tend to produce the things they have a comparative advantage in. They generally will have a comparative advantage in things that are produced that are factor intensive in the factor that they are abundant in. International trade tends to increase the demand for factors that are abundant in our country compared with other countries, and to decrease the demand for factors that are scarce in our country compared with other countries. U.S. exports tend to be human capital intensive, such as high-tech design and Hollywood movies, while U.S. imports tend to be unskilled labor intensive, such as phone assembly and clothing production. This suggests that the effect of international trade on the U.S. factor markets is to raise the wage rate of highly educated American workers and reduce the wage rate of unskilled American workers. So we have seen that. We have seen over the course of the last few decades, when international trade has become a larger part of our overall economic activity, even though it's still not a huge part, but it's always been kind of moving towards increase. During that time, we've seen a big sort of chasm between higher paid skilled workers versus lower paid unskilled workers. So wage inequality, the gap between the wages of high paid and low paid workers, has increased substantially over the last 30 years. The Heckscher-Ohlin model predicts an increase in wages of highly educated American workers and lower the wages of less educated American workers. So it makes sense for you to be here. It makes sense for you to get your degree. It makes sense for you to even go further than that. The higher skilled you are in this country, the more valuable you will be, the more you will be paid for your skill, for your human capital. And so it's not a waste of time for you to be here. All the torture that you're enduring, studying for exams and writing papers and doing all sorts of things, trying to figure out what your place in this world might ultimately wind up being, is worth your time. It is very much worth your time in terms of what you're going to benefit from in the long run from this. Was there a question? Well, I mean, we produce all sorts of things, but a lot of well, we produce stuff that we sell domestically, but goods and services overall make up about a third of our GDP, and so they are the things that services are a huge part of it. We provide a lot of services. It's very macro is where we cover it in fine detail. So if you're interested in answering that question, we go through that in very fine detail. But yeah, I like that you're thinking about these things. It's just this is not the place to kind of. I'll run out of time to cover the things I need to cover, but yeah, like I mean, there's all sorts of things that we produce. So yes, was there another question back there? No. All right. All right. So trade also reduces the income inequality between countries and poor countries as between like the populations of poor countries, um, and improve their overall standard of living by exporting to rich countries. We see that all the time with the goods that are bought from China, from India. The standards of living have been going up in these countries, not dramatically, but like it has been happening. So that's one positive outcome of all this. In some historical episodes, the impacts of international trade on factor prices have been very large. So in some instances, like wages have gone up dramatically. Most economists believe that it's only one of the several forces that do explain the growth in American wage inequality, though. So it's just one of the sources that explains why the most skilled in this country are having more and more higher wages versus the wages of those that are less skilled in this country. And again, like that issue is a complicated one, and we talk a little bit more about it in macroeconomics. Um, but there's always like work being done, sort of trying to unravel that puzzle. But definitely, there are some clear things that we can attribute that to, and one of them is international trade. All right, so let's talk about now the government getting involved in trade. Yeah. No, richer countries will generally tend to have an overall higher price level, and so then the relative to us, the goods will wind up being more expensive. Even though over time we predict in just economics in general that all prices should even out across all countries, but just the fact that there are like all sorts of like weird like trade barriers and like other policies that kind of stop that from happening, yeah, you will wind up having higher prices in more affluent countries versus poorer countries. And a lot of it depends also on the value of one country's currency in terms of another country's currency, which is also something covered in macroeconomics. Right, right. No, you're being realistic. They are a poorer country. Yeah. It, it's complicated because it doesn't just depend on like the value of currencies and like their domestic price levels. It also has to do with like their own trade pacts with exporters of iPhones. So they might have tariffs, like certain taxes on iPhones that will raise the price, and that's actually what we'll examine right now. Yeah, so like there's so many factors affecting prices, and we partly cover some of that here, but like the international issues are complicated, and we have like there's whole classes that deal with just those issues. So yeah, if you're interested in that stuff, I would suggest like going further and learning more about that stuff because it's probably one of the most important aspects of the world right now. And the more you know about that part of our world and are able to kind of like maneuver yourself through that part of the world and definitely the business side of it, the more beneficial you'll be to businesses and markets, etc. All right, so let's talk about the effects of trade protection. So since David Ricardo laid out the principle of comparative advantage via his conception of this comparative advantage model that we've been studying since chapter 2, in the early 19th century, most economists have advocated for free trade using that as the basis for justification for it. They've argued that government policy should not attempt either to reduce or to increase the level of exports and imports that occur naturally as a result of supply and demand. Despite the free trade arguments of economists, many governments use taxes and other restrictions to limit imports. So less frequently, governments offer subsidies to encourage exports. So we'll look at both sides of that. Policies that limit imports are known as trade protection or simply as protection. So obviously that's a lot of what you may be hearing now from Donald Trump. Like he is talking about like, well, he's threatened a lot of these companies that are looking to have their factories overseas to place huge tariffs on those goods, which would then make it more expensive for them to sell them domestically, which would not make it profitable for them to put their factories overseas. So he's actually stopped, I think, one factory from moving overseas. It wasn't that big of a deal. Like it didn't have that big of an impact, but he made a huge thing out of it. But ultimately, the question is like, is that a good or a bad thing? We don't know. Ultimately, like there's a lot of complicated sort of implications to trade policy in general, trade protectionism. It's a mixed bag. So we'll talk about some of that after we do the analysis with the market model. So let's just look at what the effect of a tariff is on the market. So a tariff is a form of an excise tax, a per unit tax that we studied in the tax chapter on sales of imported goods. In the distant past, tariffs were an important source of government revenue because they were relatively easy to collect. So there was a time in the 18th, well, we started the income tax, I think, in the I think it was 1912 or 14. Before that, a large part of the revenue the government collected to help it run was gotten from tariffs. So, like, that was a big source of revenue for the government. In the modern world, tariffs are usually intended to discourage imports and protect import competing domestic producers rather than as a source of government revenue. So that section of the supply curve that represented those suppliers that went out of business as a result of us importing, that represents, sometimes, depending on the industry, like influential businesses that will lobby the government to place tariffs on goods in order to not allow the prices to fall so dramatically in order to price them out of the market. So the tariff raises both the price received by domestic producers and the price paid by domestic consumers. So here we've got the situation where the country is importing because the world price is below the domestic autarky price. There's a quantity supplied, there's a quantity demanded at that world price. The difference between those is being imported. So domestic demand is being satisfied. This shortage that we see here is being satisfied by the imports being brought in from overseas. Suppose the government, though, imposes a tariff on each phone imported. So there's going to be a tax on each unit that's being imported. That's effectively going to raise the price, the world price, up to the now PT, the price with the tariff. So a tariff then raises domestic prices, leading to an increased domestic production. So you have all these suppliers now domestically that are able to supply because now the only suppliers they're going to have to compete with overseas are the ones that are willing to sell domestically at this price, which ultimately will get them back to this world price. But of course, they are going to have to pay that tariff. Like part of what they collect will be given to our government. And so the domestic price will drop down below autarky, but still it's going to be above the world price, and therefore domestic demand will decrease from that QD to QDT here. So domestic demand tax is how much there will be under this regime where there's going to be a tariff, and domestic supply will now be here. And so there's only going to be a limited amount of importers that are going to be able to sell to our domestic markets at that now higher price. And so the imports will certainly shrink, and we'll have a lot more suppliers in the country, in our own country, companies within the country that are now able to compete with the overseas suppliers. So let's look at what kind of effect that has on efficiency, which we can measure via consumer and producer surplus. So here again, we have the situation where the world price is below the autarky price, and consumer surplus is pretty enormous there. And these are the tariffs before, these are the imports before the tariff. Again, the tariff is imposed. It raises the domestic price up to the tariff price. So there are three effects on surplus as a result of the tariff. One is the higher domestic price increases producer surplus with a gain of A. So again, you're going to have, before you had the world price down here, only these domestic suppliers were able to sell, and so producer surplus was just that triangle there. But now, because of the tariff, a bunch of domestic suppliers are now able to sell at the higher price, and so therefore they are all going to have some producer surplus as well. So producer surplus will increase by this area here, which is part of what consumer surplus was without the tariff. So that's just a transfer of surplus from consumers to producers. The higher domestic prices reduces consumer surplus, a reduction equal to the sum of areas A, B, C, and D. So at this new price, again, this is how much is going to be demanded by domestic consumers. That means that the area below the demand curve up until this person here and above the tariff price is going to represent the now tariffed consumer surplus. So consumer surplus will go down by areas A, B, C, and D. So we're going to have some surplus that is going to be up in the air as far as like what's going to happen to it. Some of that is going to go to our government in the form of tariff revenue. So that's the revenue the government collects from charging the international importers on each of the units they sell via the tariff, the excise tax, the per unit tax on each of the imported goods. So remember, the distance between what's demanded domestically at the tariff price and what's supplied domestically is going to represent the imports. So that's going to be the quantity that's going to be sold. And then if you multiply that by the price, which is the difference between the tariff and the world price, then you get this area here, which is going to represent the tax revenue from the tariff. But we still have areas B and D to account for as far as surplus. So producers gain, consumers lose, and the government gains. But the consumer losses are greater than the sum of producer and government gains. So we've got, again, you've got that surplus that was consumer surplus going to suppliers, this surplus that was consumer surplus going to the government in the form of revenue, tax revenue. And what's left over is B and D, and so B and D are going to wind up just being deadweight loss. So the deadweight loss imposed on society is equal to the areas B and D. So we've got some deadweight loss there and some deadweight loss there. Tariffs generate deadweight loss because they create inefficiencies in two ways. One is that some mutually beneficial trades go unexploited, and that's this area D here. You have all these consumers that would have purchased the good at the lower world price, which are not able to now because the price has now been raised due to the tariff that's being imposed on the good. And then the second source of deadweight loss, so the economy's resources are wasted on inefficient production, and that's right there. Some producers whose cost exceeds PW produce the good, even though some of the good can be purchased abroad for PW. So essentially, because all these producers are now able to produce at this higher price, even though we could purchase the good at a lower price, then you wind up with that extra deadweight loss as well. So there's two resulting deadweight losses as a result of a tariff. So a tariff, once again, which is a tax, creates inefficiency in the market. There is some loss of mutually beneficial transactions that could occur, that don't occur as a result of the tariff. But again, you do have winners, and that is some of the domestic suppliers. And overall, there is this area here of extra surplus that does exist from opening up to trade. And we still do have this entire area of consumer and producer surplus that is maintained within the economy. And so even under the tariff, there's still a gain from trade. But as a result of the tariff, there is deadweight loss from what there could be if we just had free trade without the tariff. Yeah. Yeah, they do. Yeah. All right. Now let's look at the effect of an import quota. We're going to see that the effect of an import quota is similar to the effect of a tariff, with one small difference. So an import quota, another form of trade protection, is a legal limit on the quantity of a good that can be imported. So essentially the government can say, well, we can import, phones, but only, like 30 million phones from China. That's it. That's the limit. We can't bring in more, even though maybe, based on the world price, domestic demand exceeds domestic supply by a greater amount than 30 million. And so we could bear more than that, but the government says, no, there's going to be a limit on that. We need to protect some of our industries. So there's another way that the government might enact a trade protectionist policy. Import quotas are usually administered through licenses, just like your standard quota that we analyzed in a previous chapter when we looked at government interventions, which included price controls and quota controls. A quota on sales has the same effect as an excise tax with one difference. The money that would otherwise have accrued to the government as tax revenue becomes license holders' revenue from under a quota. So under the quota, again, only certain license holders are able to sell the good. That is how the government limits the amount of the good that's being imported. And so instead of the government getting that difference between what they were charging times the amount being sold, that money now goes to the importer who has the license to be able to sell domestically. So the quota rent is the earnings that accrue to the license holder from ownership of the right to sell the good. An import quota that limits imports, in this case, we'll say that it limits it to the difference between QDT and QST, will raise the domestic price of phones by the same amount as the tariff we considered previously. In the case of U.S. import protection, the most important import licenses, mainly for clothing and to a lesser extent sugar, are granted to foreign governments. Because the quota rents for most U.S. import quotas go to foreigners, the cost to the nation of such quotas is larger than that of a comparable tariff. So again, what this is basically telling us is that if we are going to have trade protectionism, then we should at least choose tariffs versus quotas, because under the quota system, some of that surplus winds up going to the foreign license holders versus going to our own government. So at the very least, we can maintain some of that wealth within our government, which is maintained within our economy. So the net loss to the United States from such an import quota would be equal to areas B and D, the difference between consumer losses and producer gains. So there's once again deadweight loss as a result, because there is a world price that would prevail without the quota. But again, the quota limits the amount of imports to the difference between QST and QDT. All right, and some last issues that kind of relate to the notions of trade protectionism and what sort of systems we have in place to kind of help us to get more interconnected internationally as far as trade. Trade union pacts, the European Union being probably the most prominent one, and then some other pacts such as NAFTA is one that connects us with Mexico and Canada, which Donald Trump hates a lot. It's not perfect though. We'll talk about that, but it's definitely not like the boogeyman that he makes it out to be. But he is going to dismantle it, he says. So hey, c'est la vie. Anyway, arguments for trade protection. So advocates for tariffs and import quotas offer a variety of arguments. Three common arguments are national security, job creation, and the infant industry argument. So the national security argument is based on the proposition that overseas sources of goods are vulnerable to disruption in times of international conflict. If we're dependent on other countries for certain goods, and we get into war, some sort of like world type war again, that's going to cut off the supply lines of a lot of goods, which is what happened during both world wars. You had a lot of the supply lines being cut off by enemies, and that caused a lot of shortages in this country and every other country. And so that's one argument for trade protectionism. We should have tariffs and quotas so that we don't put ourselves into that vulnerable position where we're dependent on things that we need from other countries that could get cut off during times of war. So countries should protect domestic suppliers of crucial goods with the aim to be self-sufficient in those goods. Job creation is, of course, another one of the reasons why trade protectionism can be considered relatively popular, depending on the country we're talking about. So the job creation argument points to the additional jobs created in import competing industries as a result of trade protection. Essentially, all the jobs that could go to those people if those firms weren't driven out of business because of lower international prices. Economists argue that these jobs are offset, though, by the jobs lost elsewhere, such as industries that use imported inputs and now face higher input costs. So non-economists don't always find that argument very persuasive, though. And then finally, the infant industries argument. Infant industries are new industries. And so the argument is that infant industries should be protected. So the infant industry argument, often raised in newly industrializing countries, hold that new industries require a temporary period of trade protection to get established. So a country that may not have like an automobile industry or like a tech industry, but is like developing and then maybe able to finally start developing that kind of industry, they should be protected to allow them to get to that same level as international competitors are at, so that they can compete with them. In the 1950s, many countries in Latin America imposed tariffs and import quotas on manufactured goods. Unfortunately, it is most often industries that are politically influential that gain the protection. So it doesn't necessarily have to do with like this sort of benevolent goal of like trying to protect all infant industries. The argument is usually used to justify protecting industries that would benefit those interests that are able to lobby for that kind of protection. Also, governments tend to be poor predictors of the best emerging technology, so it's really hard to say like which infant industries should be protected versus those that are just infant industries that ultimately will fail because just there wouldn't be enough international or even domestic demand for their goods. Finally, it's often very difficult to wean an industry from protection when it should be when it should be mature enough to stand on its own. So once industries have been protected and they've benefited from that, like their whole operating cost structure is based on their protection. And so oftentimes it's just really hard to get them off of that protection because then they have to completely reevaluate the costs that they face, the prices that they'll be able to charge for their goods, and ultimately how much to produce, how many folks to hire, etc. So it's like a complicated situation. Arguments for trade protection. In reality, much trade protection has little to do with arguments just described and reflects the political influence of import competing producers. So a lot of it has to do with like how wealthy essentially some of these industries are, and therefore how much influence they could have over the government by hiring lobbyists to cozy up to lawmakers. So the producers who compete with imports of a particular good are usually smaller, more cohesive group than consumers of that good. The United States has an import quota on sugar, which on average leads to a domestic price about twice the world price. This quota is difficult to rationalize in terms of an economic argument. So it's really just the sugar industry. They have really great lobbyists that are able to say, "Hey, let's protect ourselves from the sugar coming from outside," and now, and as a result, they're able to make a decent amount of profit. Consumers rarely complain about the quota because no individual consumer buys a large enough amount of sugar, and so the cost of the quota is only a few dollars per family each year, not enough to attract any notice. And so there's no public backlash to this because obviously it's not affecting us that much. But this is just an example of like the pattern that we see as far as like what kind of protections are actually being enacted. They're being enacted by wealthy industries that are benefiting, but not really in any way like benefiting the consumers, the majority of the population of the country. Politics of trade protection. When a country engages in trade protection, it hurts two groups. Aside from the adverse effect on domestic consumers, protection also hurts foreign export industries, so industries that sell goods overseas. And of course, ultimately, how we figure out how to best sort of organize our trade policies with respect to other countries is via international trade agreements, treaties in which a country promises to engage in less trade protection against the exports of another country in return for a promise by the other country to do the same for its own exports. So NAFTA, the North American Free Trade Agreement between the United States, Canada, and Mexico, is one of these type of agreements. And it's good and it's bad. It's a mixed bag. From my criticism of NAFTA is that we don't have enough protections for like international workers. So like even though we lower trade barriers between us and Mexico, which allows us to produce things cheaply in Mexico and then bring them back in here to sell them, we didn't specify enough protection for the actual workers in the factories in Mexico, and so they're being ultimately paid, low wages that maybe are relatively high relative to everybody else that's being paid, but to some extent, like maybe not. And also, like the conditions under which they're working are likely not going to be optimal. Like they're probably being overworked as far as like the amount of hours they're working. Benefits aren't being given to them. The conditions of their workplaces are unsafe. That kind of thing. Like we don't specify those things. And if a country doesn't specify them themselves, then nothing happens. And so in that sense, it's problematic. But in the sense that lowering trade barriers lowers prices and we have more gains from trade, then trade is good and trade pacts are good. It's just we need to be better about specifying the conditions under which we do engage in trade. So it's just important to kind of understand the issues and understand like the nature of each trade agreement that's being debated, the trade agreements that exist, and just kind of understanding the merits of both sides of the arguments against them, because it's not a black and white argument. Like it's a very gray area, and so it's not good to just say I am against trade or I am for free trade. Like it's just good to kind of have a well-rounded idea of like all the pros and cons, and then kind of look at each individual trade pack and say, well, this one's good because of this one's bad because of this. So the agreement, the NAFTA agreement, was signed in 1993, and by 2008 had removed all barriers to trade among the three nations. If in NAFTA, the member countries set their own tariff rates against imports from other non-member countries. Another problem, and I guess the big problem that Donald Trump highlights with respect to NAFTA is like the fact that a lot of our manufacturing has moved overseas because manufacturing can become cheaper due to labor being cheaper, like in Mexico, which means that we lose a lot of jobs here, and that is a problem. But like ultimately, like we need to kind of be in tune with progress. Like we need to understand that like maybe it is better for us to be producing certain things in other places. And therefore we can have the gains from trade, and then the domestic workforce should be retrained. Like we should be building different skills. We should be advancing our ability to produce things that aren't able to be produced like in countries like Mexico, like where they may not have like the kind of sophisticated technology that we could have here, or the means that the extent to which we can advance that technology with our human capital, with our learning and our skills. Um, so it's a very complicated issue, but again, it's important to understand it. So just make sure you kind of understand these things that as you're growing up and kind of moving through life. Don't just like shut these things out. Like know what's being talked about in the news with respect to these issues. Have an opinion about it that's well informed, because it may affect what you actually wind up doing in your life. But at the very least, like it will make you a more responsible citizen, and that's an important thing. That's something that we all need to be. We all need to be very aware of what's happening, so we can be responsible citizens. So we can be we can add to the functionality of our society, which it can be unstable, especially if people are unaware of what's going on. Like the more unaware people are, the more uncertainty there is, the more likely chaos there will be. And that's what the people in power want. The people in power want the people that are not in power to not know what they're doing and not understand what they're doing, because then they can get away with more. And so it's important for you to just kind of understand everything that's happening in the world. In Europe, 28 nations are part of an even more comprehensive agreement, the European Union, or the EU, which England is now Brexiting out of. There's also global trade agreements covering most of the world. The EU is a customs union. Tariffs are levied at the same rate as goods from outside the EU entering the union. So basically, quite a bit of Europe is involved in the EU. And then we have these other organizations, such as the World Trade Organization, the WTO, which is composed of member countries and plays two roles. Essentially, they help to settle global agreements. First, it provides a framework for massively complex negotiations involved in major international trade agreements. So when countries want to form these kind of trade agreements, the means to negotiate those pacts, which take forever, takes years. There's so much to consider on each side. Is done under the conditions set forth by the World Trade Organization. Second, the World Trade Organization resolves disputes between its members. So if there's members in a trade union that are not following the rules of the trade union, then the WTO allows for the forum for them to sort of resolve those conflicts. Currently, the World Trade Organization has 160 member countries, accounting for the bulk of world trade. Challenges to globalization. The forward march of globalization over the past century is generally considered a major political and economic success. Economists and policymakers alike have viewed growing world trade in particular as a good thing. Many people are currently having second thoughts about globalization, as we've seen with Donald Trump and Brexit. To a large extent, these second thoughts reflect two concerns shared by many economists. One is globalization and inequality. Trade with China in particular raises concerns among labor groups trying to maintain wage levels in rich countries. If again, like our workers are competing against lower wage workers in other countries, and that's going to affect wages here. Outsourcing is another concern. Modern telecommunications increasingly make it possible to engage in offshore outsourcing, in which businesses hire people in another country to perform various tasks. So again, that does include the example of like our jobs going overseas and our manufacturing jobs going overseas, but we see it even in services. Like obviously, anytime now you call any customer service center, you're talking to somebody in the Philippines, you're talking to somebody in India, you're not talking to somebody like in Downey or whatever. So there's all sorts of outsourcing going on, and these obviously are the concerns of sort of more reasonable kind of like folks that are not necessarily just interested in maybe like protecting industries. It's more these issues are more about protecting workers and like the wages of workers, and these are legitimate concerns, and we should be talking about them. But again, ultimately, we need to weigh the cost with the benefits. Like ultimately, there's a huge benefit to trade, and as a world, we need to be uniting. Like, that's the bottom line. Like, we need to be coming together as smoothly as possible. Over time, we need to just be one cohesive unit. But obviously, we've got a long time before that happens, and there's a lot of challenges to that because we, in large part, are entrenched in like old paradigms, old ideas of how we should be doing things, how we should be organizing ourselves, entrenched in traditions, entrenched in cultures. So it's just that standard conflict between old and new that like modernization always is going to face, and it's always going to be chaotic, and it's always going to have winners and losers. But you know, we always have to keep pushing towards progress. Like, that's the only thing that we can do and should do. And whenever we have achieved some progress, to take a U-turn and go in the complete opposite direction is like the worst idea possible. But that's kind of where we're at right now. We're about to kind of take that turn in this country, and England is taking it as well. Some other countries, it looks like politically they might also be leaning towards the like extreme right. I think France is in danger of falling to that. England has England is sort of in the middle right now, but we'll see. But nonetheless, ultimately, these things tend to swing one way, then they swing the other way in larger proportions. So the backlash to this period should be good, and it should get us further. But again, it's a decades-long process, so we're talking a long time. So all of you have to be patient, and you kind of have to be okay with like, you know, the imperfections of the world that we live in. But always be like aware of the problems, aware of what could be solved, aware of all the issues related to the problems, and then yourself, like, you know, doing whatever part you can within your life beyond just like satisfying your own needs and the needs of your friends and families to, you know, maybe try to play a role in getting us further. Anyway, let's do a quick practice problem and kind of close out the first part of the course. So let's look at the welfare effects of trade. Suppose the economy of Nauru, which produces fertilizer, is opening up to international trade. Illustrate a situation in which Nauru exports fertilizer to the world market. So if they're going to export fertilizer to the world market, what does that mean about the world price relative to the autarky price? It's above, right? The price is going to be above the autarky price. So you know to do that already. So explain and illustrate what happens to consumer, producer, and total surplus after Nauru opens up to trade. So again, we're talking about basically setting up a similar situation to what we've seen in the graphs that we covered. So something that you would be potentially asked to do. So the first thing is you would want to do is to draw the market in autarky. So you have to just set up a market model, make sure that price is on the y-axis, quantity is on the x-axis. You have a downward sloping demand curve, an upward sloping supply curve. They meet in the middle and they establish a price and quantity for the market. That's our consumer surplus. That's our producer surplus in autarky. Now, as you told me, the price is going to be above the autarky price when we are exporting. So there's our world price. All right, so now we're going to need to figure out what's happening with consumer surplus, what's happening with producer surplus, and what's happening with total surplus. The best way to illustrate that is with a table like we had in the slides that we looked at. So let's set that up there. All right, so that's the world price there. At the world price, we're going to have the domestic demand, which is going to be at this point here, and then we've got domestic supply that's going to be there, and obviously the difference between those will be the exports. So that will need to be identified. All right, so in autarky, we know that, so what I did here is I chopped this up. I put that world price there. I put the quantity demanded and quantity supplied at the world price. And then I kind of chopped up the diagram. And so I kind of labeled each section so that it's easy to identify them. So what is consumer surplus in autarky? ABD is consumer surplus in autarky. All right. So what is consumer surplus going to be with now trade with us exporting with this world price being above the domestic price? Just A, right? Just A, because only these consumers are going to be able to buy. That means they're the only ones that are going to have consumer surplus. So producer surplus is CF without any trade, and total surplus is going to be the sum of the two, of course. All right, so with trade, we see that consumer surplus has gone down to A. That means we've lost, so I have a column here for change, so we've lost BD there. Producer surplus, there's our price. Here's all the domestic suppliers now that are able to sell. Some they sell to domestic consumers, the rest they sell to domestic international consumers via exporting. And so producer surplus is now that entire area there. So that's BDGCF. And total surplus is now what? Right, it's going to be the sum of consumer and producer surplus under trade, right? So it's going to be the area under the triangle there and this entire purple triangle there. So we see producer surplus has now increased by BDG, and we see total surplus has now increased by how much? By G, exactly. All right, well, there you go. All right, so hold on a second.